Hey guys, this is Roxann Smithers, your trusted 360 general counsel, and this is another note from my legal pad. So today we are talking about S Corp tax election. Okay. So very often I will talk to new clients or I'll talk to entrepreneurs and I will ask them what I think should be a very simple question. And unfortunately, it will trip them up. I'll ask them, what type of entity do you have? Or what's your corporate structure? And they will be very confused. And oftentimes they'll say, I think I'm an S Corp, maybe. I'm not sure. My accountant or my CPA told me that I should become a S Corp to save on taxes. And that will lead to a very interesting conversation. Because of course, I will check their paperwork or I'll look them up with the Secretary of State because I know what has happened. And they are in fact a LLC, a limited liability company. But at some point, upon the advice of a CPA or a accountant or a tax preparer, they have made what's called an S Corp tax election with the IRS. And they're a little bit confused about what that means. So today we're going to talk about S Corp tax election so you understand what it means and how it can help you, but some of the pitfalls that you need to look out for as an entrepreneur and a business owner. So the first thing that we need to understand is the difference between corporate structure and tax treatment. Your corporate structure really means what type of legal entity is your business. That's when you went to the Secretary of State or you paid a company or someone on your behalf to actually create your business, give birth to your business baby, and create this legal entity on your behalf so that you could run your business. For a lot of entrepreneurs and business owners, that structure is the LLC, the limited liability company or corporation, depending on what you call it. Some folks, if they haven't gone through that process yet, they may still be operating in their own personal capacity. And that's when you are a sole proprietor. You may have a far more formal structure, or if you're a nonprofit, you might have a corporation, a C Corp, and your entity name ends with Inc., INC. But for a vast majority of entrepreneurs and business owners, the default entity is that LLC. That is your corporate structure. That's what type of entity you are. S Corp tax election is simply what type of treatment you want to have from the IRS, how you want to be treated with the IRS, the type of relationship you want to have with the IRS. Those are two very different things. And it's very important that folks understand that. So that's what we're here for. How that happens is because LLCs have this very unique characteristic and a place that they sit in the spectrum between other types of legal entities that you can have for your business. So business entities sort of sit on a spectrum from the least complicated, which is that sole proprietor when you're just operating in your own personal capacity, and then the most complicated, which are corporations. You can always check out our previous video about corporate entities and their structure. We go into all the different aspects of that spectrum and the different factors that go into that. But for this purpose, we're just going to talk about taxation. Sole proprietors sit at the simplest end of that spectrum where you have pass-through taxation. That means every dollar that you earn in your business simply comes in and you will report it on your personal tax return as personal income, and then it's taxed at your personal income tax rate. Corporations sit at the most complicated end of that spectrum. Dollars are going to come in. The company, the corporation, is going to pay income tax on those dollars. And then whenever you're pulling dollars out of that business as a business owner, and any other person's receiving dollars out of that business in whatever format they receive dollars out of that business, those individuals or entities are then also going to pay taxes on those dollars as they come out of that business, out of that entity. That's called double taxation. And so LLCs sit in sort of the middle where they are these chameleons, where they can decide if they want to be taxed as a sole proprietor or partnership where they're taxed directly, pass through, or if they want to be taxed like a corporation where they have double taxation. So you might be asking yourself, well, why on earth would you want to be taxed twice? That sounds like a horrible thing. Most people are trying to avoid being taxed once. Why would I want to be taxed twice? So the reason that you might actually want to be taxed twice is because depending on how those dollars are categorized, the tax rate, the percentage at which those dollars are taxed is different, higher or lower, depending on how that dollar is categorized. So the corporate tax rates, the percentage at which a dollar is taxed by a corporation, or the capital gains tax rate, meaning the percentage at which a individual pays taxes on money that it earns from investments. Those rates are lower than the rate that an individual pays when it receives a dollar as salary or as wages as a regular working person. And so because those rates are different, once you're a business owner, if your business is making enough money, there reaches a tipping point where the combination of corporate dollars and capital gains dollars can actually be lower than what you would pay if all of the dollars are taxed as income. And so you can actually save money on your taxes when the dollars are taxed twice versus the dollar being taxed once. Okay. So that's why the S Corp tax election is available and can be very attractive and beneficial to LLC owners if they're in the position to actually take advantage of it. And so now we're going to talk about how it works and some of the rules that are going to apply. And this is where a lot of business owners, unfortunately, are not receiving the rest of the advice that they need, and they get themselves into a bit of trouble. So how it works. First, what you do when you are ready to make this election is you'll let the IRS know, and they have a specific form that you can complete. Currently, it is Form 2553 that you will complete with IRS to let them know, hey, we're ready for our business to be taxed like a corporation. And the IRS has some rules about the timing of when that when that relationship will start or when that treatment will start. All right. It's usually going forward. You can't necessarily say, hey, we had a great year last year, so now we want to apply that to last year to kind of save on taxes. It's usually forward looking. All right. So you got to kind of plan ahead a little bit. But there are some rules, and those rules kind of change. So we're going to look into those specifics. And that's the carrot. So the stick is any owner in that business, any shareholder of that business that actually works in the business, running the day-to-day of that business, must now become an employee, a W-2 employee of that business. They must be on payroll, and they must receive reasonable compensation for the services that they are providing to that business. That is one of the key pieces that unfortunately a lot of entrepreneurs or business owners miss that piece. And that obligation to go on payroll and to be paid a reasonable salary does not go away just because your business is not profitable or because your business is not making a lot of money or enough money. So you want to make sure that you have sufficient revenue and cash flow to afford yourself as an employee. Now, a good rule of thumb that I utilize with clients is 130% to maybe 140% of what you are going to pay yourself or pay another employee in order to make sure you've got the cash flow. So, for example, in a great world where you are going to pay yourself $100,000 as an employee, if that's what you're going to be paying out to yourself as the compensation, annual salary, then as the employer, you need to be able to afford $130,000 or $140,000 because there are expenses that an employer is going to have. Payroll services, there's unemployment taxes, there are other contributions that a employer is going to have in terms of paying into Social Security, social safety net, that are the costs associated with being an employer. Plus, you've got to make sure that you are doing the withholding for the employees' taxes. So their state and their federal, their Social Security, all that FICA, all those initials that are going to come out of that paycheck now, that it is now the employer's responsibility to pay those things to the state and the federal government on behalf of the employee. Those things are now the responsibility of the employer. You, as your employer, have to do that. So if your business does not have enough money to afford you as a employee, then you don't have enough money to reap the benefit of S Corp tax election. And so you should not be making that election. The next step is, as an employer, you're going to have to report hiring this employee or an additional employees to the Department of Labor, your state Department of Labor, and you're going to have to comply with both state and federal employment and labor laws for those employees, okay? So reporting requirements, there are other labor laws that you're going to have to comply with. Then when it comes to tax time, the company is going to file a tax return and pay taxes on all the revenue that's come into that business. And then the business is going to issue W-2 to its employees, and then it may still issue a K-1 to you as a shareholder as well for any other funds that have come out as a owner of the business. So now you have two roles. Now you, as both a shareholder and an employee, you're going to file your own tax return, and you're going to pay taxes on those three main categories from which you may have pulled money out of the company. One, as a W-2 employee, you're going to pay taxes in your salary and wages that you received at that income tax level, of course, minus any deductions and other things that you've got going on. If the company was profitable and you pulled any profits out of the business, you will pay taxes on those profits at that lower capital gains tax rate. And then also, if you pulled any additional distributions out of the company, you're going to pay taxes on those distributions at the applicable tax rate for those distributions, depending on how they're categorized. And so the point of this is that the combination of those tax rates, once you get your final tax bill between your taxes and the company's taxes, the overall tax liability should still be lower than what you would have paid if you put everything on your personal tax return when you were just doing the pass-through taxation. That's where the benefit of this S Corp taxation election comes in. That's where the magic of the math is. Final takeaways from S Corp tax election. 1, it does not change your legal structure. If you need an analogy, think of a married couple. Married couples have the option to file tax returns jointly or to file a tax return separately in any given year. It doesn't change whether they are married or not married if 1 year they file jointly and 1 year they file separately. They did not get divorced just because they decided to file a different way with the IRS. It doesn't change their legal status at all. Second thing, S Corp tax election only helps if the company has enough money to actually have a tax liability where the combination of the different tax rates will actually save you. But the obligations that go along with the election apply whether or not the company has enough money. So you don't want to make that election if you don't have enough money to meet the obligations, because you've set yourself up for obligations without any of the benefits of the election. So for that reason, it is very important that you do not rush into this election without understanding your legal obligations, understanding the financial implications as well, and being able to plan forward and knowing that you've got the cash flow to meet those obligations and to also benefit from that election. So you've got plenty of time at any point during the life of your business. It's an election that you can do. So there's no pressure and there's no rush. If you feel like you may have done it prematurely or you're worried about whether or not you are meeting those legal obligations, be sure to follow up with your tax advisor and also to seek out your legal advisor to make sure that you are in compliance with your legal obligations, and also to think about what you might want to do if you need to unwind that election. If you would like to learn more about the attorneys at Smithers Law Group, you can always find us on the web at stulawgroup.com, and you can find us on Facebook, LinkedIn, as well as Instagram at Smithers Law Group. And this has been a note from my legal pad.